everyone, I'm Professor Harrison, and welcome back to Introduction to Finance. Today we're going to be answering one of the most important questions in finance. What exactly are companies for? What are they trying to do? Well, every company is going to tell you that it's trying to create value. Far fewer people can tell you exactly what that sentence actually means. If you can't measure value, then how are you supposed to optimize it? How are you supposed to create as much value as possible? So today we're going to end up pinning this down with three things. First, we're going to figure out what the company's goal is. Then we're going to figure out what gets measured in it. And then we're going to figure out what moves it. Let's take a look at our problem. The first part of our problem says, what is the goal of financial management? Now, a common misconception is that the goal of companies is to maximize profit. But here's the problem with that. Let's say that you want this year's profit to look better. So to do so, you cut the maintenance budget, you delay a couple hires, and you push a supplier payment into January. By doing this, your profit goes up, but nothing about the business actually got any better. In fact, the business overall might actually be in a worse position because of the fact that you didn't do your maintenance, you didn't hire the people that you needed to, and your suppliers are probably not going to be giving you any more materials anytime soon. So the issue with profit is that it's a little bit time dependent. The business might have bigger profit in the meantime, but it could actually hurt the business overall. So while profit can be something that's nice for a business to have, it's not necessarily the thing that the business needs to aim for. Similarly, companies don't just need to aim for things like growth or market share or even just being bigger, because those are things that you can temporarily inflate without actually making the business any better. So what exactly is the financial manager aiming to do? Well, the financial manager is trying to maximize something called shareholder wealth, which, as we'll see, is a direct measure of how much the company is worth to its investors. So what exactly is shareholder wealth? Well, shareholder wealth is the value of the owner's claim to the company. Concretely, it's the number of shares outstanding times the current price per share. So if a company has 40 million shares outstanding, trading at $62, then shareholder wealth ends up being about $2.5 billion. But the part that matters is where the $62 actually comes from. It is not an accounting number, and you will never find it on the balance sheet. The price is the present value of the cash flows that shareholders expect to receive from owning that share. Everything that the market believes about the company ends up being compressed into that one number. And this brings us into the last part of our problem. What are the three drivers of shareholder wealth? And in which direction does each one push value? When we think about the value of any opportunity, there are three characteristics that we need to think of when we consider how valuable cash flows are. The first, and probably the most obvious, is the amount. In general, more cash is worth more than less cash. This one's pretty obvious, and it's the one that people usually think about when they think about how much value something has. The latter two are a little bit less obvious. The second characteristic of cash is that it has a timing aspect. Specifically, how soon you get your cash ends up determining how valuable it is. Think about it this way. You have the option to choose between $100 now and $100 100 years from now. The obvious choice is to take the money now because 100 years from now you might not even be around. On top of that, if you were to take the $100 now and invest it, you almost certainly would have more than $100 by the time that you get to 100 years from now. This illustrates a key concept, that money has a time value. Getting money sooner is more valuable than getting money later because if you get the money now, you can invest it and have more money later than you would if you just let it sit. The third dimension that we're going to analyze is risk. In general, safer cash flows are worth more than riskier cash. If two projects both promise you $100,000 and one is a signed government contract while the other depends on a startup surviving, you probably want to go for the sure thing and make sure that you actually get your money. These three dimensions, the amount, timing, and risk of cash flows, are what determine the present value of any investment opportunity. And one common question here is whether these can offset each other. And the truth is that they absolutely can. In fact, the job of the financial manager is to read the trade-offs between these three dimensions. So what did we learn today? Well, there's three things worth keeping. The first is the goal of financial management is to maximize shareholder wealth, not something like profit or growth. Second, shareholder wealth is just the price of the shares times the number of shares outstanding, which gives the overall value of the company to all of its shareholders. And then finally, there's three ways that cash flows affect the value of any company. It changes depending on their amount, their timing, and their risk. In general, you want more cash sooner and safer, if at all possible. These three dimensions are the backbone of financial management.